All right, good afternoon, everyone. This is Joe Bacella at Chaikin Analytics, and I'd like to welcome you to our presentation of Trade Options Like an Expert, secrets to winning options trades from two pros. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, along with Bob Lang of Explosive Options. As a reminder, this webinar is being recorded and a copy will be sent to everyone who is registered. Please submit your questions during the webinar using the Zoom Q&A window. Before we get started, we're going to bring on our guest, Bob Lang. Bob, take it away.
Thank you very much, Joe. Happy Thursday to everybody. And we've got a nice long weekend in front of us, but better than getting your weekend started early, it's better to be here and listen to Marc and give him some attention here to help us navigate through these tough and choppy waters right now. I know that Marc's got a great slide deck to work with today, and he's going to give everybody a chance to learn from him and to see what he's thinking, what's on his mind. And I think one of the things that Marc and I talked about earlier this afternoon was that people are very puzzled about the market action right now. And I think if you're here sitting listening to the webinar today with Marc, you've done the right thing. You've made the right choice. He's going to give us all a bit of direction here and of his many years of experience. Marc's a really great friend of mine, and he is second to none when it comes to presenting and bringing in great tools. The Chaikin Money Flow, and some of the other tools that we all use every single day if we're doing technical analysis. I just can't say enough about Marc. He's wonderful, and he's my good friend, and I'm happy to present him today as our as talking about trading options like an expert. Marc, take it away.
Thank you, Bob, and welcome everybody. We're also going to be talking about a lot of stocks in the news. The FAANG stocks have been in the news, and I don't know if you realize it, but Bob Lang created the concept of the FAANG stocks, and then along with Jim Cramer popularized it. So Bob, feel free to join in when you have some comments, because these are going to be stocks that you're very familiar with. So my background is 50 years on Wall Street. For 45 years, I've been using technical analysis in combination with fundamental analysis, and that's helped me survive 10 bear markets. And I know a bear market is something you're hearing a lot about on CNBC, and we're going to try and address some of your fears. Along the way, I've been mentored by some of the smartest and most successful institutional investors, people at Fidelity, T. Rowe Price, colleagues of mine at brokerage firms. And based on everything that I've learned from colleagues and clients, I created the Chaikin Power Gauge rating in 2010 after the financial collapse left people disillusioned with the performance of their accounts, whether they were managing it themselves with an advisor, overseeing an advisor. So I felt that everybody needed independent third-party research with some predictive value to sort the good from the bad in the stock market. And this really been the culmination of my life's work, 7 years that it's been available to the public. And we're very proud of it. We're going to show you what it is and how to use it. So in today's webinar, we're going to look at 5 keys to successful options trading, including how to find the winners and the losers so that you can position your options trades properly, how to use Chaikin Money Flow to anticipate future price movement, and then use rules-based entries to get in and out of positions, how to play good defense and avoid the landmines that destroy portfolios, and this is really important in a volatile market, and then how to find probabilities-based options trades. Now, one thing I didn't mention in my introduction is that for 5 years, I ran the options department at a very fine regional brokerage firm called Tucker Anthony and R.L. Day. Over 250 brokers, tens of thousands of options traders, and sadly 95% of them lost money. And I'm going to share with you the reason that they lost money and what our answer to that is. So before we start, I'd like to start with a poll question. What risks do you see for stocks in the months ahead?
And just chiming in here, so you have a poll on your page right now. We have 4 different options for you. Take a quick second, go ahead and just respond back. The risks you're seeing: an interest rate spike, excessive valuations, a recession, or a tariff war. Go ahead and choose one, whichever one you think is resonating the most, but we'll give you about 10 seconds. We'd love to know what you think. And then after that 10 seconds, we'll actually take a look at the results here. And it looks like half of the audience has already responded. Keep it up. Let's see how many more we can get up to. And Mark, when you're ready, we'll take a look at the results.
Go to it, Joe.
All right, let's see. Tariff war, Mark.
Well, this is exactly what's on my mind, and I'm glad that only 11% of you are worried about a recession, because recessions and bear markets go together. And so I'd like to look at the market so that we put everything else we're going to talk about today in context, because it's hard to trade without some sort of sense of what the market's doing and what it's likely to do going forward. And then I'm going to give you a surprise risk that I think is really significant and explain why. So let's take a look at a one-year chart of the SPY, which is going to show you that we've gone from an uptrend on autopilot in 2017 to a roller coaster of a correction. And it's been pretty painful because we weren't used to seeing volatility. We didn't even have a pullback of 3% in 2017, and now we're seeing them on a daily basis. So here's a one-year chart of the SPY. As you know, this is the S&P 500 Index as a tradable ETF. It's the most actively traded instrument in the US markets. And the institutional community uses this to get instant equity exposure. If they've sold out of a 5 million share position in Facebook and they don't know what to buy, they'll buy the SPY just to stay fully invested and put that cash back to work. Individuals like you and me also trade this. But when we look at this one-year chart, we see that uptrend on autopilot until December, when we accelerated above that nice upper trend line, and that's when the market gets overextended. One of my mentors, Stan Burge at Tucker Anthony, used to call that a French curve or a hockey stick move. And when you get a hockey stick move, whether it's 2000 or 2007, eventually you come back down to earth. The problem is it's hard to pinpoint when. And so we came back down to earth. The market started down on February 2nd when people got concerned about inflation because of one data point, hourly wage number, when the jobs report came out on a Friday that was much higher than expected. It triggered fears of inflation. Interest rates started moving up and the decline began. And then it was accelerated by a blow-up of a very esoteric exchange-traded note. And it created margin calls. And ultimately, we traded down to 25.33 on the S&P 500 index. But we held the 200-day average. We also held the bottom of the trend line. They coincided at that point. We rallied up. We had a really steep rally. We pulled back. We made a higher high. Everything looked pretty good at that point. And then the opposite happened. Interest rates started to drop, and people got concerned because of the fears of a tariff war. And interest rates dropping hurt the financial stocks, and a whole series of other events hurt the tech stocks. And what we've done is to do what we always do when the market declines more than 10% on a closing basis, form a bottom in the shape of the letter W. Now, all through 2017 or before that, and then on this chart in 13, 14, and 15, we had what are known as V-shaped bottoms. A V-shaped bottom, as we'll see on the next chart, usually occurs when you've had a closing decline of between 5 and 10% in the S&P 500. Once you exceed 10% on a closing basis, as we did in early February, then the market takes a little more time to digest all these volatile moves, and the bottom usually happens in the form of the letter W. And that's what we appear to be forming now. And at least for the time being, we've held the 200-day moving average yet again. Now, something very interesting about seasonality. The day before Good Friday is the strongest day of the year historically, up on average in the last 20 years at 0.5%. So we exceeded that today. But April, which is coming up next week, strongest month of the year over the last 20 years, up 80% of the time with an average gain of 2%. So this is an ideal moment for us to form a W bottom. Does the market have to hold here? No, absolutely not. In fact, the Monday after Good Friday is typically down slightly. But at this point, the evidence is suggesting that we're forming a W bottom, and we'll see on the next slide that declines of between 10 and 20%, and there have been 27 of them since 1945, typically average 13%. Well, guess what? 12.4% was the closing dip. They average 4 months in length. We're now about 2 months into this. But the good news is they recovered to new highs within 3 months. Now contrast that to the V-shaped bottoms, which encourage you to buy the dips. They only average 6%. There's typically one a year. They last for a month, and you recover to new highs in a month. So this is clearly V-shaped bottom. Not. It's a W-shaped bottom. And hopefully we'll move back up to a new high. Now, a bear market is defined as a closing decline of 20% or more. And we haven't seen that since 2008. So this chart looks at these declines in a graphical way. This is currently the 5th W-shaped bottom since the bull market began. We had one in 2010. We had one in 2011. Notice in 2012, only a 9.94% closing decline. So we made a V-shaped bottom, and then we have 2 W-shaped bottoms in August, September of 2015 and December, February of 2016. So this chart is through March 9th. We've now come back down and hopefully made that W. So the takeaway from this chart should be we've been here before. As the farmer's commercial goes, I know a thing or two because I've seen a thing or two. So you've now seen a thing or two about market pullbacks. They happen. And you don't want to panic about it. But what would constitute a bear market is a drop on a closing basis in the S&P 500 below 2298, because that would represent a 20% decline from the high at 2873. Now, interestingly, we're still maintaining that nice uptrend line that you can see on this chart, and that will converge in about 3 months or 4 months with the bear market level. So we're nowhere near testing that long-term trend line. I don't think we're going to do it anytime soon. It's possible. Tariff war would be one sort of unexpected event that might trigger it. But the good news is the uptrend is intact. We've endured a lot of selling. This latest wave of selling was more emotional and fear-driven because of fears of a tariff war. But the bottom line is we believe the uptrend is intact. W bottom possibly formed already with today's rally, and you're going to look for opportunities in the market. So what should you focus on in 2018? Well, first and foremost, the trend of corporate earnings.
Hey, Mark, I was just going to say something from that last slide. You were talking about whether the trend is up. You know, today being the end of the month here, end of the quarter, I'll always look at the monthly chart to see what is the big overall longer term trend. And today was very key. Yesterday and today were very key to hold February's low. If we didn't hold February's low, we could easily have rolled over and things could have started to get ugly for the next couple of months. But we have an inside month. We have, which means we had a lower high and a higher low from February, which had that big, huge volatility range. But I'm going to agree with you because even though this was a tough month for the second month in a row, the long-term trend is still bullish. It's still intact, according to the monthly charts.
Well, that's very helpful. And interestingly, the NASDAQ actually was up for the quarter. It's the 7th quarter in a row. The S&P and the Dow broke a string of 9 up quarters. But there's been a lot of damage in the tech stocks. We'll look at some of that. But the bottom line is earnings drive stock prices. And earnings for the 4th quarter were fabulous with the tax cut. And, you know, an economy that's growing nicely in this 2 to 3% GDP range, we're in good shape. And the expectation is that earnings for 2018 are going to be up about 17%, with another 9% increase projected for 2019. So earnings look fabulous. And then you've got to focus on interest rates. And we believe interest rates are going up, not down, in spite of the action of the last 2 weeks. Because we think economy is strong and it's going to put pressure on rates. Maybe inflation heats up a little bit. But more importantly, there's a very low probability of a recession. And we're going to look at 2 very simple and reliable indicators that have always triggered before a recession. And the reason recessions are important is because bear markets and recessions go hand in hand. The only bear market I've lived through since 1966 is 1987, when there wasn't a recession, and that was triggered by something called portfolio insurance, rising interest rates, a weak dollar, a little bit of a tariff war. If that sounds familiar, don't get too worked up, but keep that in the back of your mind, because those are some of the same influences that are happening right now. Now, in a market where earnings are rising and interest rates are rising, sector and group strength and weakness is very important because it leads to better stock selection. So let's first take a look at the interest rate picture. This is the ETF called TLT. It actually measures bond prices, so it's the inverse of yield. If yield is going up, then this is going down, as was the case through early February. And we've now had a retracement rally. We broke that trend when everybody was afraid that rates were going to jump through 3%. That sort of triggered the initial market decline in February. And now we've had about a 1.5 month rally, exceeding a little bit of the long-term resistance, but retracing less than 50% of the down move in interest rates, so or the down move in bond prices. So we believe that interest rates are going to move up. And if interest rates move up, we've got a very bullish scenario, because rising earnings and higher interest rates are indicative of a strong economy, and it's the second most bullish scenario. Between 2009 and 14, we had falling rates and rising earnings. That's when we had QE to try and stimulate the economy, but this is also a very bullish scenario. This chart is courtesy of Bank of America Merrill Lynch. So we think that we're going to have rising earnings and higher interest rates in 2018 and 19. We felt the same way in 16 and 17, and that's why we had a pretty bullish market climate. Now, here are two indicators that have reliably turned down before every recession since 1960. And they're very easy to understand. And to me, that's critical. If it's esoteric, then I'm less likely to buy into it. So one of the two is the 12-month moving average of housing starts. There's a dearth of inventory for new home buyers. Millennials are buying new homes. 12-month moving average of housing starts is rising. Notice how it's fallen before every recession on this chart. And then there's something that's released by the Conference Board. It's what's known as leading economic indicators, and they compute a ratio of the leading economic to the coincident indicators. And that has also turned down before every recession. And that's making new highs. This chart is about 2 months old. The number is way up. It's about 1.25. So we monitor three indicators. The other one is the yield curve. It's flattening. Don't let that scare you. A flat yield curve actually has accompanied almost every W bottom that we've had since the bull market began. So if we're in a period of rising interest rates, based on past performance, there are certain sectors that outperform and certain sectors that underperform. What outperforms are what's known as cyclical sectors, sectors that are tied to the growth in the economy. Industrials, technology, financials, energy, and materials. And what underperforms, utilities, telecom, consumer staples, healthcare. These are the defensive sectors, typically have higher yields, so they compete with bond investors for their money. And when yields are going up, money tends to move out of these defensive sectors and into the place where you can make money in the stock market. Consumer discretionary is an outlier, and that's a good thing, because in the XLY, which is the Select Spider Sector Consumer Discretionary ETF, so it's all the large cap consumer discretionary stocks, Amazon has an outsized weighting, 20%. So if you're trading the ETF XLY, be mindful that you're really making a big bet on Amazon. So here's the risk that we didn't give you a choice to make. It's the risk involved in capitalization weighted indices and ETFs like the SPY. 40% of the SPY are technology and financial stocks. So when the FAANG stocks, which we're going to look at in a minute, start selling off, that's a disproportionate weight on the shoulder of the SPY. That, to me, is the, in addition to tariff wars, one of the biggest risks in the market. When selling begets selling, they have to sell everything. Or if the XLK, which is the technology ETF, comes under pressure because Facebook, Netflix, and Google are under pressure. They have to sell everything in the ETF when people liquidate it. So to me, this is one of the biggest risks in the market right now. Through 2017, when, as you'll see on the next slide, the FAANG stocks were rising, it worked in our favor. But when interest rates started to drop, which is typically negative for the financials, and technology stocks got hit earlier in the week, what happened? Well, we came back down to the 200-day average. Notice energy is only 5.8%, even after a rally in energy stocks. So on TV, you're hearing about sector rotation. Well, sector rotation into energy and out of technology is not going to help the S&P 500 index. So to me, the risk in capitalization-weighted indices where 5 or 6 stocks or 15% of the index is one of the bigger risks in the market. Nothing we can do about it, just something you need to be aware of. So here's a chart that I'm going to let Bob Lang speak to, because we created a FAANG chart. This is a price-weighted index of the 5 FAANG stocks. We've now added Apple to FAANG. So Bob, why don't you weigh in on what you're seeing here on this chart?
Well, this is an interesting chart, you know, and we talked before we got started here that these FAANG stocks, you know, everybody loves to trade these things. And, you know, Mark, 5 years ago when Jim Cramer and I decided to put the group together, Facebook, Amazon, Netflix, and Google, put the group together, you know, clearly no idea that it was going to have such popularity. I mean, we did the 5-year anniversary last month, and collectively, Mark, the composite of all 4 stocks are up 540%, six-fold increase, and amazing. Netflix almost up 915%. But getting back to the chart over here, listen, you know what? It seems like that trend line there has held pretty firm. It hasn't even come close to touching it since back in looks like July of 2017. So we're talking nearly a year of outperformance, and I suspect if you put the relative strength up there in the Chaikin Money Flow, it's also been pretty strong. But you know, even the best stocks have to correct, right, Mark? And I think even the best names get the biggest press, and they're always the skeptics always seem to come out. But every single time over the past 5 years, they've tried to knock down FAANG stocks. They've always come back stronger than ever, actually. And you can see that's evident of the chart. It makes higher highs and higher lows as we go along. Is it going to go up even further than this last peak above 3,400? I'm not sure, but you know, I wouldn't bet my money against it. Would you?
No, and so what we see on this chart is basically the green line is the 200-day moving average of these 5 stocks. We've added Apple in there. Okay. And what struck me was how overextended we were. This is actually something that our new market strategist, Dan Russo, came up with, how overextended we were versus the 200-day average. We were over 25% above the 200-day average at the peak in February, whereas at the peak back in July, we were only about 10.5 or 15% above the 200-day. And then underneath that is a 14-period RSI. It's an overbought, oversold indicator that Bob and I have used for years, and it shows you there was a divergence, even though you were making a big new high. This chart, the FAANG doubled in a year. So a lot of movement, and that's part of the reason that the market really took it on the chin, because when the Facebook privacy issues surfaced, and then President Trump said he was going after Amazon, and Google comes in for a little bit of scrutiny on their privacy issues, and you know, self-driving cars are a little less appealing because of a couple of deaths. You get a correction, but as Bob pointed out, we've made a lower high, a higher low rather, relative to the decline earlier in the year, and this is part of what we have to deal with every day with this new era of volatility. So let's move on and show you what we're going to be covering in this webinar. This is a 1-year chart of Red Hat. They reported earnings 3 days ago. On this chart are the key Chaikin indicators that we're going to go into in a couple of minutes, but wanted to give you an advanced look at the type of stocks and the type of buy signals and sell signals that we're going to be zeroing in on in this webinar. So Red Hat, which had a history of positive earnings surprises, and we know that because we color code each earnings report red or green. surprised again. Now, the power gauge, which is at the bottom of this chart, which is our multi-factor model based on my 30 years of working with institutions, is neutral right now. But Red Hat repeated that pattern of positive earnings surprises. They reported 73 cents versus analyst estimates of 59 on Monday. And sure enough, the stock spiked up to a new all-time high with the market still struggling. But the key thing is we had a buy signal, what we call a relative strength buy, which we'll explain in a couple of minutes. So please stay with us as we get into the meat of the stock and options trading aspect of this webinar. So our solution to your information needs is Chaikin Analytics for iPad and desktop. And we've integrated a module from Options Play, which is probability-based options strategies. Now, if you're listening to Bob Lang in the Explosive Options Trading Room or subscribing to one of his services, you're getting great options ideas. But there are roughly 1,200 stocks with liquid options trading, and nobody can possibly cover all of them. But with Options Play, once you've formed an opinion based on the Chaikin power gauge and our two technical indicators, you can then very easily find a profitable strategy. Now, Chaikin Analytics is used by the pros, quoted in the media. Bob uses it. Jim Cramer, who's a very close affiliate of Bob's, is now embracing Chaikin power gauge, as you'll see. And so this is meant to sort of validate what we're going to be teaching you here in the webinar. Now, the Chaikin power gauge improves your options trading by giving you a directional edge. I started the webinar by saying 95% of options traders lose money. The reason is they don't understand the importance of what we call a directional edge, and having a reliable sense of where the stock is headed, not just rolling the dice and buying an out-of-the-money call that expires on Friday in a stock that you're watching on CNBC, but really understanding what the fundamentals and the technicals are saying. And the way we make that so easy for you is we combine the fundamentals with the technicals into a quantitative model that we call the Chaikin power gauge rating, and then give you 6 pairs of exit and entry signals to help your timing. And obviously timing is really critical in the options market. Now, we've summed all of that up in this pyramid because successful trading demands a disciplined methodology, especially in volatile times, because there are big opportunities, but if you don't have a disciplined methodology that you're following day in and day out, you're not going to pull the trigger when those opportunities arise. So at the top of the pyramid, power gauge rating, that's our go-to fundamental indicator. Why? Because earnings and fundamentals drive stock prices. They have for the 50 years I've been on Wall Street. Industry group and sector strength is also important because it represents the macro factors that you and I don't have time or knowledge to analyze, and it puts the wind at your back. At the bottom of the period, Chaikin Money Flow, which is on every one of your online brokerage platforms, has been since 1982, even before there were online brokerage platforms, on Bloomberg and Reuters, and it's really been a guide to institutional buying and selling, and we're going to show you a very unique application of Chaikin Money Flow. It's a signal that we've been teaching professional traders and investors for over 35 years, and we're going to share it with you today. And then in the middle of that pyramid, Chaikin buy and sell signals. But at the heart of everything we do at Chaikin is a belief that fundamentals drive the market, and if you have a reliable way to gauge the fundamentals, objective, independent research based on the factors that institutional investors look at every day, you've got an edge. We call it the Chaikin directional edge. So that's what the power gauge is. It's a simple gauge that looks like the gas gauge on your car, but don't confuse simple with simplistic, because under the hood, there's a lot of powerful number crunching going on. I've said many times on these webinars that the Chaikin power gauge is like a Chevrolet with a Ferrari engine under the hood. And it can be your GPS during earnings season, as we just saw with Red Hat. Get a signal on a stock that's outperforming the market right before earnings, you want to consider taking it. So Bob and I were speaking at a conference that Street.com and Jim Cramer organized in New York in late October, a live teach-in. And as I was showing what I'm going to show you on the next slide, Jim Cramer was live tweeting that Chaikin Analytics model is the best. I used it at my old hedge fund. So what got Jim so excited about Chaikin Power Gauge rating? Well, it's a model that looks at 4 primary factors, and within each of them there are 5 sub-factors, so 20 in all. This is what's known as a multi-factor model, and a lot of institutional money is invested in indexes using multi-factor models. So value is obviously important. That's what made Warren Buffett successful. It goes all the way back to Graham and Dodd. Free cash flow to market cap and price to sales, not paying too much for dollar of revenue, are the building blocks of successful value investing. But we also have shorter term factors in there like earnings surprise. So Red Hat just reported a positive earnings surprise. What I learned from one of my mentors, George Douglas at Drexel Burnham, who did the original research on this, is that A, earnings surprises come in bunches, and B, they lead analysts to raise or lower their estimates. And academic research, which I'm not a big fan of, I'm more a fan of what the market is telling me. Academic research has shown that earnings estimate revisions are the single biggest short-term driver of stock price movement. So you've got value metrics, you've got growth metrics, you've got industry group strength, and then these shorter term, more sensitive indicators like earnings surprise and earnings estimate revision. The package works. And it works because it wasn't created by a PhD, it was created by someone with 50 years of Wall Street experience, working with institutional investors, learning what they looked at every day. And they all have different styles and different time horizons. Value investors have long-term time horizons. Growth investors may be a little more shorter time horizon. Earnings-driven investors will trade based on earnings reports. When you sum it all up, the Power Gauge rating works because it's based on how Wall Street works. So we're going to show you how to incorporate the Power Gauge rating into your decision-making process so that you can combine fundamentals and technicals. I'm going to be speaking on that subject at the Chartered Market Technicians Conference in New York in 2 weeks. And this is something that's on everybody's mind because you can't use just one. You need the combination. So why is it important? Well, in 2015, even though the S&P 500 was down only 1%, small cap stocks were in a bear market. They were mostly energy stocks. And at one point, they were down 28%. By the end of the year, down 17% using the Russell 3000 as a universe. So if you avoided the very bearish stocks, or even better, bought put options, you could have sideswiped what was a very painful experience for people buying stocks like Kinder Morgan for the yield or the fracking stocks, because there was a bear market in 15, but it wasn't in the large cap, it was in the small cap. Now, one more proof point, and then we'll get deep into the examples. 4 years ago, on April 1st of 14, we entered into a partnership with NASDAQ. We launched 3 NASDAQ Chaikin indices, large cap, small cap, and dividend achiever. They now have a 4-year real-time track record, and they've outperformed their benchmarks by between 12 and 2,200 basis points. So to put that into perspective, this year, and these indices are buy and hold, they're rebalanced once a year on April 1st. So we just ended the 4th year of the real-time track record. This year, the large cap index, the NASDAQ Chaikin Large Cap Index, outperformed the S&P by over 350 basis points without owning any of the FAANG stocks. So remember, I talked about the risk of owning a capitalization-weighted index like the SPY. Well, in February of 17, New York Life Insurance's Mainstay investment subsidiary licensed all 3 of these NASDAQ Chaikin indices. In May, they rolled out the small cap CSML, and in December, they rolled out the large cap CLRG. This is not a recommendation to buy these indices because we're not registered with any state or federal agency, but this is validation because there's now almost $800 million in these 2 ETFs, and the final criteria is that the power gauge has to be bullish to get into these ETFs on April 1st, to get into the index that the ETF is based on. A stock with a bearish rating, and we're going to see plenty of examples of that, cannot make it into the index. So you start the year with the wind at your back, because the bearish stocks, as we saw on the previous slide, underperform. So let's look at two patterns to start your learning curve about how to find winners. One we call classic Chaikin bulls. These are the stocks you want to buy. Power gauge rating is bullish, meaning those 20 factors are favorably positioned. Stock is outperforming the market, and Chaikin Money Flow, which measures institutional accumulation and distribution, shows that the institutions are buying. That's the classic pattern. So this is a one-year chart of Boeing. We read the chart here at Chaikin from the bottom up. Why? Because at the bottom is the power gauge rating as a ribbon that goes from red to yellow to green, depending on whether the power gauge is very bullish or very bearish. Right above that is our unique way of portraying relative strength to the market. We look back over 26 weeks and then convert that into a heat map. So what we like to see is the market agreeing with the model, because no matter how good your fundamental view is, if the market disagrees with you, guess who wins? The market always wins. My good friend Marty Zweig, who sadly passed on way too soon, was a stickler for that. Mr. Market always wins. And then Chaikin Money Flow to see if the institutions are enthusiastically buying or selling the stock. So all through 2017, the market agreed with the model, and you could have been buying Boeing in the 180 area. We have what we call our oversold buy signals on the screen. They work about 2 out of 3 times. They're trading signals that have about a 5 to 10 day time duration. So they're excellent entry points for options traders. And they're very simple. I learned this technique from a long distance mentor of mine, Larry Williams, who created some of the original accumulation distribution work in the 70s. A stock that you like makes a new 8-day low and gets oversold. Now we define like as the power gauge bullish. So if the power gauge is bullish and the stock pulls back and makes a new 8-day low, we consider that a low-risk entry point. And you can see on this chart that 4 out of 5 signals worked. And you also got one here in that volatile market climate right after a very bullish earnings report. Now, in my view, Boeing has held up relatively well in the face of the tariff war threat, because Boeing is sort of got a bullseye on its back, because it's an easy way for China to retaliate by buying a European version of a 767 instead of Boeing's version of it. So they can buy from Airbus. In spite of that, Boeing's held up reasonably well. Now the power gauge is neutral because it's below our long-term trend line, but it's still outperforming the market. The last buy signal didn't work. Remember, only 2 out of 3 worked, but that's your classic Chaikin bull. Now, it's one thing to know that there's a very reliable pattern, identify upside trades, but we also give you a screener that helps you zero in on those stocks. So in this screen, which I ran about 2 weeks ago for a webinar, I started with the S&P 500, because in volatile times like this, you want to go with quality. And the S&P 500 defines quality. So I screened for all the stocks with a bullish rating, and then I zeroed in on free cash flow, because that is another measure of quality. I wanted the free cash flow, one of the 20 factors in our model, to be bullish. I wanted the stock to be oversold because the market had come down, and then I was looking for stocks strong relative to the market. So I narrowed the S&P 500 down to just 30 stocks. One of them was Express Scripts at 75. 2 days after I ran the screen, Cigna made a bid for Express Scripts, and it spiked up over 90. Sometimes lucky is better than good, but there were also some really good stocks on here, like JP Morgan on its way to 120 from 111. Some of the energy stocks in the refining area that are doing well. A mixed bag of stocks, but a nice way to create a list for you to monitor. And we'll show you how we do that a little further on. Now let's look at classic Chaikin bears. Flip everything I just told you on its head. Power gauge rating is bearish, meaning that the fundamentals are negative. Stock is underperforming the market, and Chaikin Money Flow is red, not green, telling you that institutions are selling the stock. So here's a drug stock, Tesaro, part biotech, part drug. Look at the bottom-up analysis of the chart. Remember, we read the chart from the bottom up. Power gauge has been bearish for a year. This is a one-year chart. and the stock has been underperforming the market that whole year, and institutions have been selling the stock on the left side from March to July and August to the right side, which is the fall into 2018. And along the way, you got the overbought sell signals, a new 8-day high in a stock with bearish fundamentals. So that's your classic Chaikin bear. Let's look at a more recent example of that, which is Tesla. Now, I've been negative because the power gauge has been negative on Tesla. I think Elon Musk, every quarter after the earnings disappoint or the deliveries disappoint, tweets something that gets people excited. So that's why I've called him the P.T. Barnum of the 21st century. But just 3 weeks ago, right before a webinar that I gave, Tesla triggered a relative strength sell signal. This is the most powerful signal for options traders in Chaikin Analytics, and it's really easy. You can find these on stockcharts.com. A stock that is underperforming the market goes above its 21-day average and then drops below its 21-day average. That triggers the relative strength sell signal. These work 70% of the time. And the good news for options traders is they tend to persist over 4 to 8 weeks in the direction of the signal. So you can adjust your options strategies to reflect that. You can buy high delta options that are in the money, or you can buy low delta options that are out of the money, but you can give yourself more time, because one of the biggest detriments to making money in options, in addition to not having a directional edge, is premium erosion or premium decay. And if you know a stock is likely to move in a certain direction for 4 to 8 weeks, you can give yourself more time. Now, that signal came with Tesla at around 327, and when I pulled this chart earlier today, it was down 3%, under 250. It subsequently rallied. But on that webinar, we presented an option play strategy, which is what's known as a bearish vertical put spread, because those are really high probability trades that you can do more cheaply. So for $1,305, you could have in essence been short 100 shares of Tesla, which is almost a $33,000 commitment. Now, there aren't a lot of people who want to short a $33,000 worth of a stock. Margin calls are a problem, and you've got to have a margin account, but you can put on this vertical put spread. So in this case, $1,305, that's all you can lose. The cost of a put spread, just like the cost of an option, is all you can lose. So you know what your risk is. In this case, that was roughly 4.5%, 4.3%. But look at the profit potential. This was buying the Tesla 327.5 put that expires on April 27th. So you had about 6 weeks to go, 7 weeks, and selling the 290 put to reduce the cost. Because if you had bought that put outright, it would have cost you almost $2,000. So you cut back the dollars that you're risking, and you increase your risk and return. So the potential profit was $2,400. Look where that spread was today. It had widened out to almost $3,300. So a $2,000 profit, almost 85% of the total potential in just 3 weeks.
Hey,
And
Mark.
so, yeah, Bob.
Mark, if you don't mind, I wanted to tell the audience, tell everybody that I saw this potential trade through using Chaikin Analytics. I didn't do the exact trade, but I did a variation of it, and it worked absolutely, just worked like a charm. This is one of the reasons why I use the Chaikin Analytics every single day. I did get into this trade, a different strike, but I went with a slightly out of the money put. I didn't go with the spread, but you know, I paid very similar to what you did here, and it worked like a charm. So.
And I would imagine you've already booked your profit on that, Bob.
I left it. I left it on. I think on Tuesday or Wednesday. I missed a little bit of the down. I think I took it off on Tuesday. So I missed the down move yesterday, but I didn't really care. I mean, listen, you know, and you know what we always talk about. You know, you're never going to catch the top. You're never going to catch the bottom. I just want to take the trend and get mine in the middle there.
Yep. Hey, Bob, you're actually not alone here. There's one of our attendees just chatted into the Q&A window saying, it took some time, but finally Tesla got crushed and my shorts paid off. My largest single gain in 4 years of trading. Thank you, Mark. You were saying Tesla bearish forever.
Amazing. So one thing I was going to mention as well, Mark, is you raised a really great point about how buying premium is very difficult for a lot of people to handle. I get it, I understand, but if you think if anybody out there thinks in terms of value of the option, why is an option so expensive? And I got one answer for that. It's because it's valuable. Think in terms of why is a diamond worth so much money? Because they're valuable, they're rare, and when I find options that are expensive, that means that they're in heavy demand, and there's just maybe not a lot of supply out there, or there may be a lot of supply, but there's just not a lot of people out there who want to give them up. Meaning, market makers don't want to sell to you their options because they want to hold on to them. So if you get in there and disrupt that sort of behavior, you're going to probably end up on the winning side of things, especially if you're using the Chaikin analytics to guide you.
Yeah, you need that directional edge, and I prefer to sort of pare back that expensive cost by selling an option. You limit your profit. It's not unlimited, but if you're constantly reducing your cost on every trade, over time that really adds up. And so this is just an example of a put spread that worked, but it worked within the last 3 weeks, and really pleased that one of our members cashed in on that. Tesla's been a tough stock to be short because Elon Musk is a promoter. And actually, he lies. But nobody has called him on the lies, except that, the death of someone due to a self-driving car and their production problems, and the whistleblower who's telling you that they're delivering unsafe parts and not testing them long enough. It's starting to gang up on Elon Musk. So would I short it down here? Probably not. Look for a rally like we got today, but it's certainly not a stock that I want to own long term. So like to look at 3 other patterns. We've touched on them already. Dynamic duo, personality changes, and then that special signal that I think is going to blow your mind because it's so logical and it reflects what's going on Wall Street, and you can find it on any online brokerage platform, stock charts, or on Chaikin Analytics. We just combine everything on one chart. So what is the dynamic duo? It's that combination of fundamentals and technicals that is so powerful, and I'm going to be speaking at this conference in 2 weeks. Chaikin Power Gauge gives you a quick and accurate read of the fundamental potential of a stock and relative strength the way we do it as a heat map, because you could go to Investors Business Daily and see relative strength as a number from 1 to 99. To me, that's information overload, and that's one of the biggest problems we have as traders. So we portray it as a heat map. When they agree, we call that the dynamic duo being bullish, and it finds big winners. And when they disagree on the downside, as we'll see, that's bearish, and that's where you're going to get downside acceleration. Now, one caveat, and we're going to see it when we look at General Electric. Relative strength stands alone as a bullish or bearish indicator. Now, what do I mean by that? Well, the power gauge is our go-to indicator. But as we said, the market is the ultimate arbiter of whether you make money or lose money. And so you can have momentum stocks like Tesla or Chipotle back in 2015, 16 into 17 that go up where the fundamentals are stretched or very expensive. And then you can have stocks where the fundamentals are very poor and the stock is underperforming. So relative strength is really critical, and you'll see why in a minute. So the other pattern that we're talking about here is what we call personality changes. We define a personality change as a stock that was outperforming the market, so our relative strength indicator is green, that begins underperforming the market. And it's really critical that you spot these, and vice versa, stocks that have been underperforming the market that begin to outperform, and we make it really easy. We color code this. Think of this as a stochastic of relative strength. Now, the key to making and keeping profits is to spot these personality changes. Why? Because one of the biggest problems we have as investors is we get stubborn. We fall in love with a stock, or we love to hate a stock, like me with Tesla. And there are times when we're wrong, and you've got to be able to spot those personality changes. So let's look at 2 examples. Here's Michael Kors, very fine apparel company, was in a downtrend, underperforming the market. How do we know that? Because our relative strength indicator is red. And then in August of 17, they reported a positive earnings surprise. It was one of many, but it really took Wall Street by surprise. Wall Street had been negative because they were afraid of a border tariff war and with Mexico and increasing the cost of imported goods. But the bottom line was the power gauge had been bullish, but once you got that earnings surprise, you got a really big explosion. Some of that was short covering, some of that was institutional buying, and you do not want to buy that spike up in price. If you were fortunate enough to be long the stock heading into earnings, you want to take advantage of that and sell. What you want to wait for is a pullback, and ideally that first buy signal after the spike up, after the bullish personality change. And that occurred on a pullback, roughly an 8-day pullback. That's why we got our oversold buy signal to the 41 level. And the stock rallied, gave you another oversold buy signal. Then you had a second positive earnings surprise. Remember, I started out by saying earnings surprises come in bunches. This time you spiked up and went sideways for 7 days and then continued on to the 67 level. And then when the market took it on the chin starting on February 2nd, you got an oversold buy signal, and that came 2 days ahead of another bullish earnings surprise, where in the midst of this big waterfall decline, what did Coors do? It traded up to 70, made a new all-time high. But then volatility kicked in and it dropped all the way down to 56. So you want to sell these spikes after earnings reports. If you're already in the trade, book the profit. Don't be greedy. And then we've pulled back and finally got another oversold buy signal. And we're going to come back to Coors and show you how to find stocks like Michael Coors, which turned bullish in August. Now, here's a bearish personality change. Remember, we started by saying that there are certain sectors that do poorly in a rising interest rate environment, and that's the REIT sector. So Avalon Bay is one of the 2 largest REITs that deal in rental housing. So they're taking a double hit. Interest rates hurt them because it makes bonds more competitive when interest rates are rising, and millennials are starting to buy houses instead of rent. So in July, you had a bearish personality change. Can you see how simple this is to spot on the chart? It doesn't require a lot of heavy-duty math or screening. You're looking at this chart in a weak sector, and what do you see? A bearish personality change. And then negative earnings surprises. When the power gauge goes bearish, now you have the dynamic duo negative on the downside. So you're looking for selling opportunities. And look how many of them there were. This is our money flow sell signal. A stock with, in this case, negative money flow, so the institutions are selling it, moves above a short-term moving average and then drops back below it. Call that a money flow sell. I've highlighted the third one on the screen because Avalon Bay was already down from 200 to 165 when that sell occurred, but it was a very profitable sell signal where you could have put on a put spread. The point I want to make is it's never too late to sell a stock when the power gauge is bearish and it's underperforming the market and money flow is weak, because you don't know where the bottom's going to be. And that signal turned out to be very profitable. Now, here's that secret sell signal that 95% of traders don't see and don't know about. We call it a bearish money flow sell alert. So I'm going to go back in time on advanced auto parts. This chart ends in May of 2017. Power gauge had been bearish. It went through a period where it jumped up on a positive earnings surprise. So there's your momentum, relative strength, unsupported by fundamentals. So these stocks can go up for a long time. But when you may or equal that previous peak, Chaikin Money Flow, which normally fluctuates around a zero line, should have gone green. Instead, it stayed negative, even though the stock had equaled its all-time high. We call that a bearish money flow sell alert. We're going to show you 2 or 3 more examples of that. Smart money is selling. Institutions are selling. They're getting out under the cover of strength. And we identified the auto parts group back further along in April, where 3 of them, O'Reilly, Advanced Auto Parts, and AutoZone, all had the same pattern. But it was preceded in Advanced Auto Parts by this bearish money flow sell alert. you can get out of a long position near the peak, which is so hard in Wall Street, as you know, and then you're looking for sell signals. So right before this earnings report in May, we got a overbought sell signal. So a new 8-day high with relative strength in the power gauge bearish. You got a negative earnings surprise. That signal came at about 150. The stock's ultimate low, 78.87. So from that sell signal at the 150 level, you very quickly went below 100. Now that's a profitable option setup. And then you rallied again before the next earnings report, got a relative strength sell signal. Remember, they last 4 to 8 weeks. Another negative earnings surprise, so the stock went from 110 all the way down to 80. The ultimate low was 78.87. That's the power of combining fundamentals with technicals and having a good rules-based entry and exit methodology. So another example of a bearish money flow sell alert actually came in a stock that we had liked on the long side, D.R. Horton, in the home building group, was our bullish stock of the week in my weekly Market Insights newsletter on September 24th. The stock was $36.90. So why did I like it? Well, everything lined up. The power gauge was bullish. It was outperforming the market. Chaikin Money Flow was telling us there was big institutional buying. It had triggered a buy signal 2 weeks earlier. And when I saw that pullback to the 21-day average, I made it my bullish stock of the week. It rallied from 36.90 to 53. And look what happened at the top. You made a new all-time high at the upper volatility band, and look where Chaikin Money Flow was. Unbelievable opportunity if you were still long the stock to get out at or near the all-time high. Now, I wouldn't have shorted the stock. Why? Because the power gauge was still bullish and it was still outperforming the market, but I would ignore the next buy signal because smart money was getting out of it. You went from institutions buying it to institutions selling it. Now, just at the point that we got that oversold buy signal, Barron's had an article on the home building stocks recommending them. A little late to the party. Now, I read Barron's every Saturday, but I filter their ideas through the lens of the power gauge rating. Now what's happened is institutions are selling. You got a bearish personality change. The power gauge is neutral. And the home builders are having a tough time getting out of their own way. This was a wonderful play from September into January. But that play is now over. Move on. So everything we've been talking about, we call the ideal setup. Warren Buffett has famously said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. So he calls that the fat pitch. We call it the ideal setup. And the final piece of the ideal setup are the 6 pairs of buy and sell signals that give you better timed exits and entries. And we've looked at 3 of them on the webinar. You can go to our website, chaikinanalytics.com, where we explain the basis for all 6 of these signals. Whether you're a member of Chaikin Analytics or a visitor, we try to be as transparent as possible. So as with finding classic bulls and bears, we want to make it easy to find these signals when they trigger. So for every list that you create in Chaikin Analytics, every ETF, every index, we have a dashboard. This is from our iPad product that shows you which stocks have triggered buy and sell signals based on the previous night's close. This is a dashboard from August 10th when I was giving a webinar. And on the long side, I had a lot to choose from. There was Boeing at 234, which was on its way to 360. There was Michael Kors at 45. As we see, that peaked at 70. And we're going to zero in on Trinity Industries because it's another example of a bearish money flow sell alert. And then Bed Bath & Beyond as a relative strength sell signal at 29. So here's Trinity Industries. That buy signal came here in August with the price at 28. It spiked up on some sort of takeover rumors at 35. So what do we do with a spike like that? We take advantage of it and we sell it. Then it pulled back, responded negatively to an earnings report, and then it plowed ahead from 30 all the way to 38. And look what happened at the ultimate peak. bearish money flow sell alert. Again, a stock that makes or equals its previous high at or near the upper volatility band where money flow stays red instead of going green. So if you were still in the stock, it's a great time to exit, and then you just take it off your buy-side radar screen and you move on. Now, on the sell side, Bed Bath & Beyond, that red arrow shows you where that relative strength sell signal came in 28.90 on its way down to 18. You had had a previous relative strength sell signal ahead of earnings. These are really profitable options entries back in June. Negative earnings surprise, you spiked down from 36 all the way to 28. Then you rallied up a bit, got that signal we were looking at. And then just before the next earnings report, you got a relative strength sell signal again where the stock gapped down. So you see how these patterns repeat over and over and over again. And even though the power gauge turned bullish for about a month in January, it's now neutral. The stock has continued to underperform the market, so you don't want to bottom fish, and we're going to talk about that in a minute. And you've had another series of relative strength sell signals. So the key here is to follow the discipline for your exits and entries. Now, I said that one of the 5 points we're going to cover is good defense, because good defense leads to good offense. We saw that with the Eagles' hometown team. We're here in Philadelphia, 28 of us. The parade passed right under our office. We were on the 18th floor, and very exciting. But defense won the game for the Eagles. So how do you play good defense? Well, A, you avoid weak sectors and industry groups. That immediately puts the wind at your back. You don't bottom fish. You eliminate bearish rated stocks from your 401k plan, and you trade them from the short side, not the long side. You spot bearish personality changes, so you're not caught in stocks like Avalon Bay, and we're going to see a couple of more examples. And you use put options to protect your portfolio. But you can also make money on the downside by spotting the bearish stocks and putting on trading positions, not just protective puts. So here's an example of a stock that we liked. It was actually our classic Chaikin bull example for over 9 months in 17. Reading the chart from the bottom up, power gauge is bullish, outperforming the market, institutional buying, oversold buy signals, positive earnings surprises. That's what you need to know to trade successfully. Institutions were buying the stock, and we know that because Chaikin Money Flow was consistently green for 3 months. And everything was going really well. Stock made a new all-time high just before the market broke in February. And then suddenly everything changed. Now, institutions went from buying to selling the stock. You had a bearish personality change. And then 2.5 weeks ago, when the stock was stabilizing, you gapped down dramatically. Why did it gap down? Because Cigna made a bid for Express Scripts, a controversial pharmacy benefit management stock. The institutional investors don't like that. They put on arbitrage positions or they sold the stock. So that's why it's so important to know that a bearish personality change has taken place. That actually came ahead of the takeover bid for Express Scripts. So if you were in the stock at 150, you saw it go up above 220, not the worst thing in the world to have gotten out at the 200 level if you're a long-term investor. You protected most of your profits by following the bearish personality change. Now, at the Kramer webinar that Bob Lang and I spoke at, live event in New York in October, I said that bottom fishing is the most expensive sport in America. And TheStreet.com liked that quote enough that they built a whole series of stories around that. And we had keyed in on Chipotle, which is still struggling, Under Armour, and Mattel. So let's look at a chart on Mattel that they wrote a story about. That webinar or seminar was in October. We had had sell signals and negative earnings surprises in this toy manufacturer. It's been disadvantaged because Toys R Us went out of business. And then after the teaching event, the stock had a negative earnings surprise and made a new low down around $12. And then there were takeover rumors. that they were going to merge with Hasbro or be taken over by Hasbro. You don't want to jump on that. That's another form of bottom fishing. And look what happened. Takeover rumors never materialized into a deal. And Mattel has continued to make new 52-week lows when the market is struggling but near to new 52-week highs. I mentioned General Electric earlier. Reading the chart from the bottom up, power gauge has been neutral. I wish it had gone bearish. We would have looked like a hero. But it was underperforming the market. So remember I said that relative strength stands alone as a bullish or bearish indicator. When you have a stock like GE that's consistently making new 52-week lows when the Dow is making new 52-week highs, don't buck that trend. Do not bottom fish. Instead, you want to look for these relative strength sell signals as an opportunity to get out of a stale position, or even better, buy a bearish put spread. And you had 4 opportunities to do that, 5 if you look at the beginning of the chart, and every one of them was profitable. Why? Because General Electric is a mess, and they keep reporting disappointing earnings. They're disappointing Wall Street analysts. Today there were some rumors about Warren Buffett possibly taking an interest in the stock. Do not bottom fish. You'll be right 1 out of 5 times, and the other 4 times you're going to lose sleep and lose money, and it wipes out any potential gains. And it just skews your trading and your mind in the wrong direction. And then finally, Albemarle, chemical stock, gave us a relative strength sell signal after a bearish personality change. Institutions were selling the stock. I made that my bearish stock of the week up here at 133 about 2.5 months ago, and the stock has dropped all the way to 90. And then there was a second signal that triggered ahead of earnings. So these patterns repeat over and over and over again. You play good defense by keeping these stocks out of your long portfolio, trading them from the short side, finding put buying opportunities or put vertical spread opportunities. That's good defense. Now let's look at a current one, and I'm going to let Bob talk about this because it's one of his FAANG stocks. We had a negative personality change on Facebook. Power gauge rating had been bullish, but it started to underperform the market long before these privacy issues cropped up. And then we got a relative strength sell signal. So Bob, what do you see on this chart of Facebook?
Well, basically, Mark, what I see is that the signals that you got on Chaikin Analytics were there far before the breakdown happened. And if there's anything that's worth more than gold, that's probably it right here. I mean, I want to be in front of the big moves before they happen, whether they go up or down. You know, clearly it's a broken chart over here right now, and it's going to take a long time. I mean, listen, I do see positive Chaikin money flow, but it's the other indicators that aren't confirming it. Look at the relative strength versus the SPY. It's been red. It's been in the negative since. Looks like December, Mark, is that right?
Yes.
And it flipped up and down, but consistently, you're looking at since December, you're not seeing that really, really strong relative strength that you saw last spring up until around November when we were, green in the power gauge for most of the time. And you got the little yellow triangles there. I mean, everything was kicking in high gear. You wanted to stay with the stock, but when that thing started to turn, the yellow flags went up, and the warning flags went up, and this is not a stock you want to get long in. And probably I would suspect the next move is going to be a shorter sell on the next rally upwards. Is that I'm not going to get in front of the move, but I suspect that's probably the trend that we're going to be looking at.
And that's my thinking as well, Bob, because right now analysts are maintaining their earnings estimates. I mean, Facebook is a behemoth, 40 to 50 billion in advertising revenues. But if the psychology around the stock changes and around the app and people start moving away from it, then guess what? That 40 to 50 billion in advertising revenue is going to shrink, and analysts are going to start cutting their estimates, and that's when the power gauge will go bearish. Notice how well these relative strength buy signals worked when everything was lined up. That's your fat pitch. Power gauge bullish, outperforming the market, heavy institutional accumulation, pull back under the 21-day average and move back above it. Now, because the relative strength is bearish, you got that signal. It came at 170, and guess what? The stock bottomed out below 150.
You know what's great about markets, market. Obviously, you've known this, is that you'll always have another opportunity to get on board. So if we're talking about, okay, well, Facebook has tripped up about 30 points from the initiation of the relative strength sell signal, where the red arrow is, where we were pointing with the yellow arrow. It's gone down about, looks like it's about 25 points roughly. I think it closed at 160 today, maybe 159. So 20 points. And you might say to yourself, well, shoot, I missed it. But I'm here to tell you that that's not the case. And I just want to go back, Mark, to one chart that you don't have it in your slide deck over here, but this is the first webinar we did together. You identified Wynn Resorts as one of the best selling. I remember like it was yesterday, Mark. It was a couple of years ago. I still remember thinking it was one of the best relative strength sell signals that you said you've ever seen, because it just kept coming over and over and over again. Every single time it would get oversold, it would rally back, and then another relative strength sell signal, rally back, another sell signal. I want to say there was probably at least 4 to 6 of those things. So you had an opportunity to get on board if you were paying attention. The first move, maybe it's the biggest one, maybe it's the strongest one, maybe it's the most powerful one. That may be the case over here. But listen, you know what? I'll take 5 follow-on moves versus the first one every single time.
Well, I agree. And Wynn, by the way, was our classic bear for over a year because it did such a steep downtrend. So let's move on to what Bob just alluded to, profiting from volatility, because we're in a volatile market climate. So to me, volatility equals opportunity. We're looking to buy stocks with bullish power gauge ratings, but at depressed prices. You don't have to pay up for stocks in this kind of market. So a couple of stocks that we've really liked. This one happens to be in the large cap ETF that was in place for a year. So the power gauge identified this April of last year. And you just had a relative strength buy signal as you came off the lows. Why? Because Progressive reported February sales numbers. They report monthly numbers and then quarterly earnings, and they just blew people away. So this was a signal that triggered at 56. Could have bought it at 54 because it triggered the previous day, and it went up to 62. So whereas some of the other financial stocks have failed to make new highs, Progressive just continues to deliver. And then Intel, bullish power gauge rating. The semiconductor group was very strong. It's sort of weakened now with the weakness in Lam Research and Applied Materials and NVIDIA, which was reversed a bit today. But look at that wonderful oversold buy signal. Take advantage of volatility. When everything lines up, power gauge, relative strength, and money flow, you get a signal, follow it, and you get rewarded. The stock went from 44 to 52. That's a nice move in a market where people are confused. So I've spared you a lot of testimonials because you've seen too many of them on webinars. But this one I love, a 10x return in 5 days. In the 5 business days I've been using Chaikin, I've paid for the subscription over tenfold. These initial results are nothing short of outstanding, and they really are because of our team of dedicated people like Joe Bacella and his customer success team. Our salespeople are well versed in the product. So I'm going to end up by showing you something we're very proud of. We won the Benziga FinTech Award last May for Best Ideas Platform, and we won it for something that we call our Stock Discovery Engine. So we looked at Michael Kors earlier, it turned bullish in August. We seeded Michael Kors here right now into the Discovery Engine to try and find stocks like Michael Kors, and we came up with 5 apparel stocks with bullish ratings. One of them was Columbia. So here's a chart of Columbia. After Michael Kors turned bullish back in August, if you had seeded the Discovery Engine in August or September with Michael Kors, you would have gotten Columbia, which had a bullish rating and was under accumulation, and that was in the $60 area on the way to 80 or 78. So using the Stock Discovery Engine, which works the way Spotify finds you music or Netflix finds you films, you find ideas, and then you find out which apparel stocks to avoid, like Hanes Brands, and guess. So a very powerful ideas engine. We're very proud of that. It's cutting edge technology. You're reading about AI, which is questionable. This really works. So everything we've been looking at has to do with what's in Chaikin Analytics for both iPad and desktop. It includes our 20-factor power gauge model and the stock discovery engine. The screener that you've seen, the options play ideas, and normally Chaikin Analytics sells for $2,195 for an annual subscription. Our website to take advantage of this is chaikinanalytics.com/expert. But as a webinar special for the explosive options community, we'd like to take $300 off the price of Chaikin Analytics, reducing the cost for an annual subscription to $1,895. This offer expires Sunday, Easter Sunday at midnight. So consider becoming a member of the Chaikin community and taking advantage of all the other things that we have to offer. Now, Bob Lang, who really is a good friend, was kind enough to encourage Jim Cramer to have me on Mad Money. And Jim said, I learned a long time ago not to be on the other side of a Chaikin trade. High praise indeed from someone who really does know what he's talking about, and in person is about the nicest human being you'll ever meet. Very calm, as Bob will tell you, just a wonderful guy. But very proud of this shout out from Jim Cramer. So in addition to what we've showed you, you get intraday charts, so you don't have to run to your online brokerage firm to see what the intraday activity is, our earnings alerts, and then my weekly market insights. That's where I recommended Albemarle as a short and D.R. Horton as a buy in my stock of the week segment. So as a Chaikin member, 3 other really important benefits. Member-only access to our weekly Monday strategy webinar hosted by Joe Bacella, featuring our market strategist, Dan Russo, with institutional technical background. Unlimited coaching. If you need one-on-one coaching, we'll do it. We also have 3 times a week small group sessions. And then Dan Russo's daily morning insights, which is a very quick read on what's going on in the market pre-opening. Now, as a special inducement, what they call in this business a fast action bonus, to get you to take advantage of everything you get as a member of the Chaikin community, I'd like to take an additional $100 off the cost. $400 off, reducing it to $1,795, plus for anybody who calls before midnight tonight or orders before midnight tonight, we'll schedule a one-on-one session with me, and this offer does expire at midnight. It's actually the last time we're going to make this offer because my travel schedule has become so intense that I've had to cancel 1 or 2 and reschedule them, and I don't like to do that. So order by midnight, $400 off, plus a one-on-one phone session with me, chaikinanalytics.com/expert. And with that, I'd like to thank my good friend and partner, Bob Lang. And Bob, you may have a couple of words that you want to close the webinar with.
Thanks very much, Mark. I wanted to thank everyone for joining in, and this is an incredibly generous offer by you, Mark, not just for the Chaikin Analytics, but also the chance to talk with you on the phone for a good 30 minutes. And I know last time I offered that, I had 8 people who I talked to on the phone. It was a great time, but I mean, 8 times a half an hour, you know, that's 4 hours worth of talking. And I think I lost my voice at the end of the week. But, and so I know with your travel schedule, it probably makes a little bit of a challenge. But this is a great offer. And I'll tell everybody that I don't start my day without taking a look at Chaikin Analytics, and I use it regularly during the day to help me find trade ideas. The options platform is second to none. It's fantastic, and I don't think that it's a tool that you should not have in your quiver. I think everybody should have access to this, and the great thing about this, Mark, and I'll just close with this, is that it's constantly evolving. It's constantly improving. It's constantly getting better. They don't rest. They don't stop at something and say, oh, okay, well, that's good enough. We're done, and we'll just pass it on. Every time I take a look at this thing, Mark, there's something new and there's something better, and I have to get better along with it. And it refines my searches and my research, and it allows me to do things not just better but faster. And when it comes to options trading, you need speed, you need quickness, you need agility, and Chaikin Analytics just does it for me. So I encourage everybody to give it a shot, take it for a drive, and you'll see what I'm talking about.
Well, thank you, Bob. Really treasure the friendship that we've established over the last 4 years. And coming soon in our release this weekend, we're going to have a note capability so that people can write notes as to why they bought a position or sold it. And then in June, finally, our ratings for exchange traded funds based on fundamentals and technicals. So lots more coming. And with that, I'd like to turn it back to Joe Bacella to close the webinar.
All right. Thank you both, gentlemen, so much for your time. Again, Mark's offer is $17.95 for a full year to Chaikin Analytics. The link to that is chaikinanalytics.com/experts. You can find that in your chat room right now. You can also give us a call at 877-978-6257. Mark offered a one-on-one session for if you subscribe tonight. I've been working with Mark for about 3.5 years. I have an incredible luxury, an incredible benefit of being able to walk into his office and ask his advice about the market, about this stock, about that, anything. So I'm coming right from me. Take advantage of that offer. That is about as good of an opportunity as you'll ever find. Before we do that, we're going to onboard you. We have an onboard session taking place tomorrow at 2:00 Eastern time. We want to show you the ropes. We want to make sure that the time you spend with Mark is most valuable. So we're going to go over all the ins and outs, show you how to create different lists, find all the different features so that by the time you're ready to have your conversation with Mark, you're going to have it as valuable of a conversation as possible about really the important stuff. So, but first things first, take advantage of Mark's offer, $17.95 for a full year to Chaikin Analytics. That's chaikinanalytics.com/experts, or give us a call at 877-978-6257. Until then, have a great evening, and we will see you on tomorrow's onboard session.